Good day, investors. As promised, we are going to look at Canadian oil and gas companies, and let's start this with PrairieSky royalty. So understanding the business, it's relatively simple, durable royalty business with no capex. What's their competitive edge is they have a fee-based low-cost model with large lands and a diversified operator base. Management is disciplined, aligned with the shareholder, and have a great track record of capital allocation. From the margin of safety perspective, you want to buy a stock when it's cheap enough to limit risks. I think the company is really high quality. The cash flows are relatively predictable if you compare it to producer companies, but valuation is a bit too high for me. The company trades on the Toronto Stock Exchange. I believe you can buy it on OTC markets. Around 6.3 billion Canadian dollar capex. Market capitalization. The model is simple. You are a royalty business, no drilling, no operating, no capital costs. So you are good. Revenue mainly comes from oil, gas, and some natural gas liquids. They have a huge land, and as you can also see here, they are the largest in Canada for this type of business. And because of the royalty model, you have lower risks to commodity price volatility than producers because you just take a bite. What your risk is if oil prices go lower, of course your earnings go lower because your bite is going to be smaller. And if the operators start to cut back on volume, that also hurts you more. So you want oil prices to be healthy enough for the producers to keep producing. They started with 5.2 million acres in Alberta on when they IPO'd in 2014. Today, they more than 3x'd that number, and they spread not just in Alberta, but in West Canada. Of course, you are probably familiar with Canada and their government. The western part of the country, where the oil and gas is relatively more conservative, and they are way more pro oil and gas, as one might suspect, given they have oil and gas. The eastern part of the country, with the capital and recent governments, were much more against oil and gas. Maybe with the new government, after the Trudeau government, it's gonna change, and that would give an extra boost for PrairieSky. On reserve replacement, you can see that in 2021 they had a large heritage acquisition, which boosted their reserves and production. If you compare to 24 production versus reserves, it's around 6.9 years worth of production. Of course, they have to keep investing to keep those royalty channels flowing, but it's far from being at risk of running out. So when we look at their Q3 numbers, I would like to highlight a couple things. So first, we want to look at the breakdown of royalty income versus other revenue. So if you look here, year to date, around 7.6% is coming from other revenue, which is fees, for example. And then the royalty revenue is more than 90%. It's 9.24-ish. I'm just guessing. So 92 versus 8%. So that's tilting the favor for royalty. Production revenue, which means commodity price sensitivity, although not as volatile and as sensitive as producers. And then if you look at the breakdown of how their volumes look like, you can see it here. So you have 25.8 thousand barrels of oil per day equivalent production, and the breakdown is mostly coming from crude oil, and then you can see the rest breakdown. Okay, what is the company's moat? So moat is basically the protection against competitors and against the market, so it's a long-term durable advantage. Being one of the largest or the largest independent royalty land base in Canada, it's scarce, it's hard to replicate, you already have a large asset base. It's fee simple ownership status, you have perpetual rights and long-term cash flow durability. This also gives you, how the industry likes to call it, optionality, that there is possibly more oil than you originally priced in to your royalty agreement, so you're gonna get more out of it. You paid 10 expecting to receive 20, but you're gonna receive 25 or 30, so that's your upside optionality. The operator base is highly diversified. So as you can see here, top 10 payers represent 51%, top 25 74. So you are not really reliant on a couple big players, but they are multiple companies. They have a low cost structure, so the operating margins are really nice. So maybe I will have some slides on it, but I think revenue versus like cash flow from operations is around like 90%. So they have really nice gross margins. Of course, there are some weaknesses to this business. They are fully exposed to commodity price swings, even though not as much as producers, and they are reliant on operator activity. I would like to mention that Canada is not really the cheapest producers globally, so volumes could be cut. As you can see on this chart, in general, do they say what this is? Yeah, so this is basically Canadian production versus Prairie. You can see Canadian production went up when oil prices are healthier, and it comes down when oil prices are less healthy on the growth. What that means, Canada has relative higher cost production. Of course, it differs between sources. So let's say bitumen, like oil sands, are higher cost than some other sources, more conventional sources. But you can see that you don't have to generalize in Canada. So Prairie can grow its production by being more selective which assets they want to get royalties in. And of course, they did an acquisition for Heritage, which improves their production, but they had nice organic production anyway. So to summarize up their moat is basically you can compare what they are exposed to and what they are not exposed to. So they're exposed to high margin cash flow streams, right? You also have less staff. You don't have to manage all those integrated oil company stuff. New discovery and exploration optionality. So that's what I mentioned. You pay you pay 10 to receive 20, but in the end you're gonna receive 30. So that's your optionality upside. Commodity price optionality, right? So as long as the producer can keep up production, so as long as the price stays relatively okay, above break even, or let's say break even, they're gonna make money. So that's good. But if commodity prices go higher, then they're gonna make more money, of course. Yes, secondary, tertiary recoveries, of course. Let's say shale opportunities, right? They are flexible. They are not so if you think about, let's say, gold companies, that there is also royalties in gold. If you have 4 mines, you are pretty heavily exposed to basically 4 big assets. If you are the same sized royalty company as the company owns the 4 mines, maybe you can get exposure to like 100 different mines instead of 4 for the same amount of capital. And then they have, of course, growth and ownership and undeveloped acres, so they can keep growing. What they don't have exposure to is capital costs, right? Maintenance capital. So that's something that makes royalty companies a good, let's say, Buffett-like business, where you can be long-term compounders and you don't have to spend a lot to stand still. That's your maintenance. You have no environmental liabilities. You are not the operator of the mine. Of course, operations and operating costs. So these day-to-day inflation pressures, somebody's getting an injury, or you have a mine collapse. You can think of negative examples. You have capital costs on expenditure not just to maintain but to grow the business. You can get all those operator risks out. Let's look at management. So management, strongly aligned. Executives and the board owns significant amount of shares. I didn't put it here, but you can look up the ownership structure. So the management has skin in the game. They focus on stable free cash flows and disciplined acquisitions. 2 slides later, you will see what I mean, and it's going to be really positive. They have a really good history of shareholder returns, dividends, and buybacks, which they call opportunistic buybacks. You'll see that also it's really positive, and the balance sheet is extremely conservative. Basically, they have no debt. What I have a little bit of issue with is their management incentive pay is not as detailed as I would like to see. what I could find in their 2024 annual report is basically they have a share-based compensation plan, which relies on total shareholder returns, of course, which is capital appreciation plus dividends. That's it. And their dividend policy and its intention is to focus on creating value for shareholders by distributing cash flow to shareholders. So you have dividends in the form of dividends, yeah, and opportunistic share repurchases. Yes. So opportunistic is a keyword, really important. I'm gonna say more about that. And if you want to see, this is how management expense was for the share-based compensation. Oh yeah, this is the CEO. So the guy looks like a Chad. So he looks like John Gold from Atlas Shrugged, from Ayn Rand. If you watched maybe the movies, although there are 3 movies and each movie has basically different actors, so it's a really weird execution. But if you think about John Gold, this guy looks like a big oil man, John Gold. So maybe one plus point for the company that and for the management that your CEO is basically a Chad. And this is where I want to talk about their history of capital allocation. So they are doing counter-cyclical capital deployment. If you've been watching this channel, I mentioned it multiple times that when what companies usually do is let's look at this blue chart. This is VTI oil. So what companies usually do, if oil price is high, your share price is going to be also high, because if you look at any stock today, or oil stock or iron ore or gold, anything, the producer company trades with the underlying asset, which makes sense because when oil price is high, you're gonna have more cash flow coming in, and then companies tend to buy back shares when price is already high, which is really stupid because that's pro-cyclical. You buy high, and then when oil prices are low, you cannot buy back shares anymore because you bought back shares at the top and you spent all the money, and now the underlying commodity is so low you don't have as much cash at hand to spend. So what I like to say is that when the times are good, commodity producers should pay down debt, and then if they really can't do much with the money, they should just pay dividends or retain some of those earnings for poorer times, right? So if you think of a Chevron, they can grow their dividends 38 years straight because what they do is they just retain some earnings and then they spread it out over the course of their years. So they can always just keep on increasing dividends because they have retained earnings and they have a pristine balance sheet. What the Petrobras does is when 2022 happened, they paid out like 37 billion in dividends, which was, I think the cash flow was 39 billion free cash flow. So they basically just paid out everything. They didn't do buybacks, they just paid you cash. That's also an option. So either do one of those, because when oil prices are high, probably you cannot do much acquisitions because valuations are going to be high for those assets, and your share price is going to be high. So do anything but those two, basically. Pay down debt, pay dividends, retain some earnings. So what Prairie did, or has done so far, is that, okay, they IPO'd at the peak of kind of the oil boom before the bust, before the shale bust. And what they do acquisitions here, they do acquisitions here, they do acquisitions here. They start doing buybacks when oil is lower, and then when they see an opportunity, they're gonna push for really strong buybacks. So you see the crash with COVID, oil prices collapse, they start to do big buybacks. So this is how you do capital allocation. This is how you do acquisitions. This is how you do buybacks. So 10 out of 10. From the valuation perspective, I'm using growth assumptions of 7% based on their latest number, 1% each for nat gas and nat gas liquids. I use a 10% discounter. And based on this, I come up with a valuation of around 16.6 Canadian dollars. Compared to the 10 cap and the 7-year average 10 cap. Of course, the 7-year average 10 cap is going to be lower because the company has been growing nicely. The company also is relatively profitable. So if you look at the return equity, return investments, they are decent. They have a huge free cash flow margin given their fee type of royalty business. Their debt to equity is insanely low. So they basically operate with no debt. Their coverage ratio is off the charts, so easily can cover the zero debt. And then they have 63% current ratio. which they can get by given the nature of their business of stable cash flows. The dividend is just below 4%, and it's not a surprise because the free cash flow yield based on 2024 numbers is relative to today's market capitalization is 5.3%. So it's basically an 80% payout ratio. Of course, the company has risks, so oil and gas prices will influence its earnings, but we have to keep in mind they are less volatile than producers. They just have to have prices good enough for producers to keep producing. Of course, if oil and gas prices go higher, they're gonna make more money, but they are less volatile. And the regulatory shift in Canada, currently it's a positive. You have a change in government in favor of oil and gas relative what they had before. But this could shift. Just to summarize, the company is clear, durable business model, simple and high quality. You can understand it. They have a strong moat, royalty advantages, and high resilience. So all good. Management is excellent, highly aligned with shareholder value creation, and they are amazing capital allocators, counter-cyclical, as we have seen. The only issue, oh yeah, I would like to add, they have a chat CEO. Maybe that's a plus. And my only issue so far with this company is the valuation metric. So I want to see an expected return of 10%. Today I see more of a like 7% on this. And if you look at the company valuation on the summary, looking at all the companies we have looked at so far, relative to the price today of 27, I think the value is just around 17. That means it should come down for 1, get an expected return of 10%, and 2, to leave some room for the margin of safety. If you enjoyed this video, please like and subscribe, and let me know down in the comments what type of businesses you want me to analyze. For now, I'm gonna keep looking at Canadian oil and gas. Thank you.